Do you know how banks actually get money to give to people for loans and mortgages? The theory behind this is that banks get money from people's savings and then use that money to give to other people as loans or mortgages. So the money that you save is the money that banks use for loans and mortgages. And while this is slightly true, this isn't actually 100% accurate. You see, the actual real way that banks give other people money and make money is when someone applies for a loan or a mortgage, the bank creates that money and then gives it to the person. So for example, if I requested £100 from a loan from the bank in order to get a new watch, then the bank will create those £100, give that to me, and then when I use that money, I can buy a new watch. And what happens is that when I buy the new watch, of course I have a new watch, but I have to pay the money back to the bank. So then I pay the money back to the bank, and that £100 that was given to you gets wiped off, deleted. So essentially think of it like this. The bank had £0. It created £100, which it then gave to you. So now it has a net worth of minus £100. But you gave the money back, so now it's back to £0. So essentially nothing was spent at all. However, both of you are like happy and successful because of course I got the new watch, and what the bank does is that they get interest from you. So they ask you to pay a certain percentage of interest back. You pay that interest back, and that's how they get the money and profits from giving you that loan or mortgage. So what happens if you don't actually manage to pay all the money back for a loan or a mortgage? So for example, if I take a £100,000 loan from a bank and I fail to pay back all of that money, then the bank instead has to use its reserves in order to pay that money back. And so this is why banks nowadays are very cautious about giving money away, because during 2009 there was a big crash in the UK where unfortunately what happened was that banks were lending money very irresponsibly. They were just giving it to people that there wasn't 100% chance that they could actually pay it back. So what ended up happening is they ended up giving it irresponsibly, and then these people weren't able to pay the money back. So what you had is that banks were in huge debt, and so people that obviously were losing their money and had their money in banks, they went to try and get the money off banks, but of course the banks never had that money. It didn't exist. So what happened was that it created a huge problem, and the government instead had to intervene and basically save these banks from bankruptcy by giving them billions of pounds, but in return they essentially own the banks and get a high amount of shares. So now you know how banks create money in order to lend to other people. Thank you.